Open up a stock chart, and you are immediately hit with a wall of flashing green and red data. To the average observer, this endless stream of numbers feels like a giant, frantic guessing game, where real wealth is generated and destroyed every single second. But inside the world of professional finance, that chaos is divided into two entirely separate disciplines. Both chase the exact same dollar, but they do so using completely opposite blueprints. On one side, traders operate at high velocity to capture immediate price movements. On the other, investors play a slow, deliberate game of long-term ownership. Confusing these two paths and their respective time horizons often turns market participation into a game of chance. Without a clear distinction between velocity and compounding, capital tends to erode through a lack of technical or fundamental direction. Let's break down the micro-engine first. In the market, trading is the mechanical loop of purchasing an asset and liquidating it within a highly compressed time frame. The goal is to capture rapid price velocity. To execute this effectively, a trader sets aside a company's underlying business health. They rely instead on technical analysis, a system built on the belief that historical price patterns reliably repeat themselves over time. This visualization is a candlestick chart, where each candle represents the precise price velocity of an asset. When buying volume outpaces selling volume, the price is pushed upward, forming a green candle. When selling pressure is higher, the value is driven down, forming a red candle. By dissecting these historical graphs, traders forecast specific behavioral boundaries. They look for a support floor, where the price historically stops dropping and reverses upward, and a resistance ceiling, where the price tends to hit a limit and fall back down. In a perfect trade, the math is elementary. You deploy capital at a verified $10 support line, ride the upward momentum, and liquidate your position at the $13 resistance ceiling. You lock in a $3 profit and prepare for the next entry signal. However, technical analysis operates on probabilities, not certainties. If the market moves against a prediction, capital is lost instantly. To mitigate this, traders use a stop loss, a tool that automatically triggers a sell order when an asset hits a predetermined price to halt further losses. This shows the mathematical and psychological friction that often ruins retail accounts. You buy at $10, but the price drops, triggering your stop loss at $8. You take a $2 loss. If you view a minor recovery as a sign to buy back in at $9 and the price breaks downward again, your losses compound. Because of these risks, the trading engine demands extreme emotional discipline and constant monitor tracking. It functions as a demanding career rather than a source of passive income. The second pathway, investing, requires a massive shift in perspective. Here, the time horizon expands from compressed intraday minutes to macro cycles spanning years or even decades. Investors largely ignore short-term candle fluctuations. Their core tool is fundamental analysis, the rigorous evaluation of a corporation's structural financial health and macroeconomic performance. Instead of charting price momentum, an investor audits corporate ledgers. They look for rock-solid economic moats, consistent revenue growth, and business models that show the potential to scale profitably over time. This timeline shows how slow burn wealth is actually generated. Imagine a $500 principal investment in a company that is gaining massive market share. Over a 5-year macro cycle, as the underlying corporate revenue expands, the share price scales upward in tandem. During that expansion, elite corporations often distribute a portion of their earnings directly back to equity holders. These regular dividend checks provide a passive yield that layers on top of the growing principal investment. After 5 years, you might decide to liquidate. Driven by long-term corporate growth, your capital gains and accumulated dividend yields can turn that initial $500 outlay into a significantly larger asset. We can see this compounding power validated in the historical data of major corporations. A $300 equity position in Apple, acquired in 2008, would have expanded to approximately $22,000 by 2024 if held passively for 16 years. True investing offers a calculated approach where capital compounds quietly in the background. It allows wealth to grow over time, as long as the underlying business remains fundamentally healthy. Both mathematical engines seek to buy low and sell high, yet their required time horizons and analytical tools remain distinct. One focuses on the velocity of the price candle, while the other audits the health of the business. The trader's profile is defined by a desire for rapid capital velocity and the ability to stomach high-risk drawdowns. As market icons like George Soros have shown, this path requires a deep commitment to tracking market depth and executing orders in real time. Conversely, long-term investing is engineered for those who require a stable architecture for wealth expansion. It allows capital to work quietly, without the need to monitor live price screens constantly. But the primary barrier here is psychological. As Warren Buffett famously observed, most retail participants struggle with this model because they lack the patience to build wealth slowly. It requires a vision that spans decades. Choosing between high-velocity trading and slow-burn investing requires more than a preference for speed. It demands a specific set of skills. Deploying capital without mastering the underlying mechanics of either path leaves your wealth at the mercy of the odds found on a casino floor.